If you are a business owner in Canada, you have probably asked yourself the million-dollar question. Should I pay myself a salary or stick to dividends? Now like we are in 2026, the math has shifted. Making the wrong choice based on outdated advice could cost you thousands in unnecessary tax leakage right out of your corporate bank account. In fact, for a standard $100,000 withdrawal in Ontario this year, picking the wrong route can cost you exactly $2,800 in pure tax waste. Today, we are looking at the exact 2026 numbers to make sure you keep that cash instead of giving it to the CRA. If you are new to the channel, welcome. My name is Wei, and I'm the founder of Wei Jiang CPA Professional Corporation. We are a newly incorporated CPA firm dedicated to helping business owners, professionals, and owner-managers to optimize their corporate structures so that they can keep more of what they earn. To understand why the math is breaking down this year, we have to look at the concept of integration. In a perfect world, the Income Tax Act wants you to pay the exactly same amount of total tax, whether you are taking a salary or a dividend. It uses a system where dividends are grossed up and given a tax credit to reflect the tax your corporation already paid. But the perfect integration is a myth. Let's look at the actual 2026 data to see where the system cracks. Let's model a real-world scenario we run for clients at my firm. An Ontario corporation earns $100,000 in pre-tax income. First, let's talk about the salary route. Under subsection 18(1)(a) of the Act, your corporation can deduct a salary as a legitimate business expense. Because it is fully deductible, look at what happens. Corporate pre-tax income is $100,000. Corporate deduction for salary is minus $100,000. That leaves corporate taxable income at exactly $0. The corporation pays zero corporate tax. The entire $100,000 flows directly to you as employment income. Personally, in Ontario, hitting a $100,000 income puts you in a combined marginal tax bracket of roughly 31% to 34%. After applying basic personal credits, your personal tax bill is about $17,900. That leaves you, the owner, with $82,100 in net cash. Now, let's look at the non-eligible dividend route for that exactly same $100,000. This applies to active business profits taxed at a lower small business rate. This path gets a bit more complex. Step 1. Your corporation pays tax first. In 2026, with updated Ontario small business tax rate at 11.7%, your company pays $11,700 in corporate tax. Step 2. This leaves $88,300 sitting in a corporate bank account to pay out to you as a dividend. Step 3. When you pay that $88,300 to yourself, subsection 82(1)(b) mandates a 15% statutory gross up, which adds $13,245. You must report $101,545 as your taxable amount personally. Step 4. You calculate your personal tax on that amount, but then you apply a dividend tax credit to compensate for the tax the corporation already paid. Thanks to those credits, your personal tax payable drops to just about $9,000. Sounds amazing, right? But hold on. Look at the combined total. When you add the $11,700 corporate tax to your $9,000 personal tax, your total tax bill is $20,700. Your net cash in pocket is $79,300. Comparing the two, the salary route leaves you with $82,100, while the dividend route leaves you with $79,300. That is a $2,800 tax leakage just for choosing the dividends. So, case closed, salary wins, right? Not so fast. This is exactly why my firm, Wei Jiang CPA Professional Corporation, takes a holistic view of your business. Because tax efficiency isn't just about this one calculation. There are deeper variables at play. First, the CPP hit. Salaries trigger mandatory Canada pension plan contributions. Paying both the employee and employer portions can drastically alter your immediate cash flow. Dividends completely escape CPP. Second, RRSP rule. Salary creates earned income under subsection 146(1), which builds your RRSP contribution rule. Paying a $100,000 salary creates $18,000 of RRSP rule. Dividends creates $0. Third, the child care trap. If you have child care expenses, Section 63 allows you to deduct them, but only against the earned income. If you take 100% dividends, your child care deduction drops to 0. And fourth, the passive income grind down. If your corporation holds investments and earns more than $50,000 in passive income, your small business threshold starts to shrink. If it hits $150,000, your corporate tax rate spikes from 11.7% to 26.5%. When that happens, paying a salary to put down your corporate taxable income becomes wildly attractive. As you can see, what looks like a simple choice on a spreadsheet is actually a deeply integrated puzzle involving your retirement goals, your family situation, and your corporate structure. There's no one-size-fits-all answer. If you want to stop guessing, eliminate tax leakage, and build a customized compensation strategy that keeps more money in your pocket, we need to talk. At Wei Jiang CPA Professional Corporation, we specialized in taking the stress out of corporate tax planning so you can focus on growing your business. Click the link in the description below to book a strategy consultation with our team today. Don't leave your 2026 tax planning to chance. If you found this breakdown helpful, hit that subscribe button, drop a comment with your questions, and I will see you in the next video.